Follow my instructions step by step on the TradingView platform. First, open your chart. Then click on Indicators and search for MACD. Add the MACD indicator 2 times so you have 2 separate MACDs on your chart. Now you're going to adjust the settings on both of them. I'm going to show you a specific combination of these 2 MACDs that work together to highlight clearer buy and sell signals than using a single standard MACD by itself. Alright, let's start with the first MACD, the one at the bottom. Open its settings. Go to the Inputs tab. Set Fast Length to 100. Set Slow Length to 200. Set Signal Length to 50. Next, go to the Style tab. Turn off the MACD line and turn off the signal line. You want this first MACD to display only the histogram. That's it for the first MACD. Now go to the second MACD and open its settings. In the Inputs tab, set Fast Length to 8. Set Slow Length to. Set Signal Length to. Then go to the Style tab. This time, remove the histogram. You want only the 2 lines visible. For the MACD line, change the color to white. For the signal line, change the color to orange. Increase the line thickness so both lines are easy to see. Perfect. At this point, you should have one MACD showing only a histogram and another MACD showing only the MACD line and signal line with the colors and thickness you set. Now we'll combine both MACDs into one pane so they sit on top of each other. Go to the MACD that is currently in the lower pane. Click the More Options menu. Choose Move To, then select Existing Pane above so it moves into the same pane as the other MACD. Then, for that same MACD, click More again. Find the option that says Pin to Scale and select Pin to Scale. This helps keep the visuals consistent and easier to read when both indicators share the same space. Now the 2 MACDs are combined. On the screen, it may look like a normal MACD at first glance because you see a histogram plus 2 lines. But the key difference is this. The histogram is not calculated from the same settings as the 2 lines. The histogram you're seeing is based on longer moving average lengths, which makes it slower and more stable. It helps you understand the bigger directional shift in the market, like trend direction and early trend changes. The white and orange lines are based on shorter lengths, so they react faster. These lines help you track short-term momentum swings, especially pullbacks inside a new move. So you're basically using 2 speeds at the same time. The long-length histogram acts like your trend filter. The short-length lines act like your entry timing tool. Here's the idea. First, you use the histogram to detect when the market may be transitioning into a new trend. Then, instead of entering immediately, you wait for a pullback. Finally, you use the white and orange lines to confirm when that pullback likely ends, so you can enter with lower risk. Let's break this down into a short setup and a long setup. Short trade setup. Start with the histogram because it gives you the trend clue. When the histogram is below the center line and it's red, that suggests bearish conditions and downside trend pressure. When the histogram flips from above the center line to below it and the color shifts to red, that is an early warning that a downtrend may be starting. But you do not enter a trade just because of that flip. That alone can create false signals, especially in choppy markets. You need confirmation. After the histogram flips below the center line and turns red, your next step is to wait for a pullback. A pullback is basically a temporary move against the new direction. If the reversal is real and sellers truly have control, the pullback should struggle to break the previous swing high. It should stall, then price should resume downward movement to new lows. This is where the white and orange lines help. Once the histogram has flipped bearish, watch the white line and orange line. Wait for the white line to cross above the orange line. That crossover suggests a short-term bullish momentum pop, which often matches a pullback during a downtrend shift. Then you wait. When the pullback is finishing, you want to see the white line close back below the orange line. That downward cross is your timing confirmation that the pullback likely ended and downside momentum may be returning. In practice, that is the point where a short entry becomes more logical. After the bearish histogram flip, after the pullback forms, and after the white line closes below the orange line. For risk placement, a common approach is to place the stop loss above the pullback swing high. For the target, a simple method is to aim for a risk-to-reward ratio of 2, meaning your target distance is about twice your stop distance. That's the short setup. Long trade setup. Now, let's reverse the logic for a long position. When the histogram is above the center line and it's green, that suggests bullish conditions and upward trend pressure. When the histogram flips from below the center line to above it, and the color turns green, that is an early signal that an uptrend may be forming. Again, you don't enter immediately on that flip. You want confirmation. After the histogram flips bullish, you wait for a pullback. If the reversal is real and buyers truly have control, the pullback should be relatively limited, then price should turn and push to higher levels. To detect the pullback and its end, use the white and orange lines. After the histogram turns green, wait for the white line to cross below the orange line. That often signals short-term bearish momentum, which matches a pullback happening during an early uptrend shift. Then you wait for the pullback to finish. When the white line closes back above the orange line, that gives you your timing confirmation that the pullback may be over and upside momentum may be resuming. In practice, that is where a long entry becomes more logical. After the bullish histogram flip, after the pullback forms, and after the white line closes above the orange line. For risk placement, you can place the stop loss below the pullback low. For the target, you can again use a risk-to-reward ratio of 2. Important risk note. Keep in mind what this approach is trying to do. This is a reversal-based strategy. You're attempting to catch the early stage of a new trend, right as the market shifts direction. Because you're trading near potential turning points, this method can carry more risk than a pure trend-following strategy. That's why risk management matters a lot here. A simple rule many traders use is the 1% rule, where you risk only about 1% of your account on a single trade. The goal is to prevent a string of losses from doing serious damage to your account. Even if your entries are solid, losing trades will still happen, so you need position sizing and stops that keep you in the game. That's the full setup. Thanks for watching, and if you have questions about the settings, the crossover confirmations, or where to place stops and targets, leave your question and I'll respond.